Good morning, my name is Winslow Taylor, and we also have Tiffany Tyler, Josh Tyler, and Colleen Sullivan are here this morning to discuss and explain mezzanine financing. Mezzanine financing is not a very well-known form of financing, and it's kind of a non-traditional avenue. It's a blend of debt financing and equity financing. Typically, mezzanine financing relies on a higher than normal interest rate to become profitable, and it's usually used in short-term situations such as if a company has, say, a new product coming out or expansion, or if they need capital in the short term. And today it's kind of a dense subject, so we're going to use some hypos to better explain it and allow you to kind of follow the situation and understand the process better. So first of all, we're going to use two companies, a larger and a smaller company. The first company we're going to use is Hatteras Yachts. They produce $1 million plus yachts from 50 to over 100 feet, and they're located in New Bern, North Carolina, which is just here in the eastern part of the state. And they're very large worldwide production company. And the second company we're going to use is a smaller, also boating company. They produce pleasure boats in the 15 to 30 foot range, and it's Grady White Yachts, and they're actually located close to New Bern and Greenville, North Carolina as well. Here's the background and the breakdown for where the mezzanine financing would come into play. There's obviously the large company, which is Hatteras, smaller company, which is Grady White. And the story is that due to the recent downturn in the economy, Grady White, which is a small boat builder specializing in boats from 17 to 35 feet, they've struggled financially, but they have developed a new boat which is much more economical, efficient, and just a better product. But unfortunately, the bank in this situation, they will not loan Grady White the entire amount which they need to finish production and put this product on the market. The Grady White really believes that they have a revolutionary product that will change both the recreational market and the future of boating. So here we have, again, Hatteras, which is a large production builder just down the road. They're obviously done a bunch of market research, and they understand the demand and the increased demand for smaller boats is, everything is getting more expensive, fuel and all that. Hatteras has been in touch with Grady White, and they know also that Grady White has this great product coming out, but and they also know that Grady White cannot secure a traditional loan in order to put the final touches on the product. This is kind of where mezzanine financing comes into play. In this situation, Hatteras Yachts, the larger company, will offer a mezzanine loan to Grady White for a higher than normal interest rate. Again, essentially, Hatteras's loan will bridge the gap necessary that the bank has given to Grady White in order Grady White can produce this product that they have. And although these loans are quite risky, but they can be beneficial to Hatteras as well. For instance, Hatteras has done plenty of research. They know the changing demand of the marketplace, and they believe, and all their research shows, that Grady White will be successful, which means that their mezzanine loan will in fact also be profitable to Hatteras as well. And here are kind of some numbers we're going to throw in there to make it, easier to understand and follow. We have Grady White has a production budget of $2 million. They need an additional $3 million to finance the production and testing of their new boat. The bank, which is hesitant to loan $3 million in this recession on basically a company that produces a toy, offers them a $1 million loan at 4.5% interest. Therefore, Grady White really needs this additional $2 million in order to facilitate the production of their new product. And Hatteras knows the shifting market demand in boats. They see the potential in Grady White's product, and they offer to finance the additional $2 million at a 15% interest rate. And we're going to switch it up.
So we want to discuss what exactly is mezzanine financing. So the first thing we're going to do is look at the overall capital structure. At the bottom you have equity, which is the capital investment that is invested by the owners and shareholders. At the top, you have the senior debt, which is the money loaned through traditional means, such as through a bank. It's usually secured and can have either a fixed or floating rate. And then in the middle, you have the mezzanine capital, which bridges the gap between the senior debt and the equity when both together are insufficient to fund the project. The mezzanine capital is subordinate to the senior debt, but is senior to the equity. And mezzanine financing is popular during times when the credit markets are dislocated and capital is scarce. And during these times, mezzanine capital is often one of the limited sources of capital available. Mezzanine financing is used in many ways. It can be used for growth capital through acquisition, funding a new product line, such as our hypothetical of Grady White, as well as an expansion. It can be also used for a leveraged buyout through real estate, where it bridges the gap between the first mortgage and the equity investment, and can also be used for restructuring. There are many possible investors, including pension funds, business development companies, private equity funds, and banks that have established mezzanine departments. There are several requirements in order for a company to obtain a mezzanine loan. They must demonstrate a track record in the industry with an established reputation and product, excuse me, a history of profitability, and a viable expansion plan for the business. While there are several terms that are usually seen in many of the mezzanine loans, the terms are often highly negotiated and are customized to each individual situation. Several of the typical terms are that it's usually unsecured, the maturity is usually 5 to 7 years, and the rate of return is usually between 15 and 30%, with an average about 20%. The role of an attorney, both the debtor's lawyer and the lender's lawyer, will review all the terms, make sure everything's good for their particular person that they're, company that they're representing. And the debtor's lawyer will also ensure that there are no personal guarantees in the loan, so that the individual, the owners and stockholders or shareholders aren't personally responsible for any of the debts. So the structure of the loan, there are several pieces. There's the principal, there's a cash interest, which is paid on a periodic basis based on the percentage of the outstanding balance. There's also the payable in kind interest, which is also periodic payment, but instead of being paid directly to the lender, it's compounded back into the outstanding principal payment. Therefore, it basically makes it so that the interest is earning more interest. There's an equity component. There can be several options under the equity component. There's warrants or options to purchase a specified percentage of the equity, a right to co-invest alongside the controlling stockholder or private equity sponsor. And lastly, there's also conversion, which allows the mezzanine investor to convert all or part of their principal investment into common equity. And lastly, there's several other possible pieces, which can be such things as like royalty payments and a bonus interest payment. So here we have a chart where, so Hatteras is going to loan Grady White the $2 million over 4 years. In each year, the PIK interest, which is 3% of the outstanding balance, is added to the outstanding balance each year. They'll pay 15% or principal payment of $250,000 each year, and the interest is 15%. So that'd be based on how much the outstanding balance remains. And then by the end of the 4 years, when they pay it off in full, they'll also pay a $500,000 bonus payment. So in the end, after those 4 years, Hatteras would earn $1,730,000 between the interest, the PIK interest, and the bonus payment. So, almost basically doubling what they loaned to Grady White. We're going to compare traditional financing to mezzanine financing. Under traditional financing, the company has equity, but it needs more, and so it goes to the bank. and asks for money. Well, here Grady White goes and asks for $3 million. The bank's hesitant to loan the full $3 million, so they only agreed to loan $1 million. And that leaves Grady White with a $2 million deficit. Whereas with mezzanine financing, there's two particular options. The first is that the company can seek mezzanine financing after they obtain the traditional loan. So here the bank still loans the $1 million, there's no change there. But then Hatteras will loan the mezzanine loan up $2 million, and that leaves Grady White with a $0 deficit. And then the other option is that the company can seek mezzanine financing prior to seeking the traditional loan. Banks see mezzanine financing as equity, and also that the lender is a possible risk-reducing partner, because the lender wants to get their money back. They want their rate of return, so they're going to take a more active role in making sure that the company pays their money back and ensure the success of the business. So therefore, the bank is more willing to lend additional money on top of what they would have lent before. So here, Grady White obtains the mezzanine loan of $1 million from Hatteras, and the bank is now willing to lend $2 million at the lower 4.5 interest rate because they feel it's a better investment. So that still leaves Grady White with a $0 deficit.
So now we're going to discuss some of the risks and advantages to be found in investing through mezzanine financing. First, some of the risks for the party who is going to be borrowing through mezzanine financing. The obvious one that's been stated is that it's a high interest rate that must be repaid to the lender. It's between 15 and 30% usually, and on average it's more than 20%. The second risk to the borrower is that it displaces stockholders and owners in the priority of payment in the event of default. So in the event of a default, the senior lenders like a bank or a bondholder will typically be paid first, then the mezzanine lender will be paid, then a preferred stockholder, and then common stockholders. So in the event of default, it's going to be less likely that there will be money left over for preferred stockholders or common stockholders. And the third major risk in borrowing through mezzanine financing is that there will typically be some loss of control because the lending party is getting equity in the company. They have some rights in management and control. For instance, through the ALTA endorsement terms, mezzanine lenders have to be notified anytime the lending party wants to make an amendment or an endorsement on their title policy, and those amendments actually cannot go through without the mezzanine lender's approval, so that somewhat hampers the borrower's ability to make business decisions.
Okay, so for limitations to lending through mezzanine financing, the mezzanine lender is basically subject to all of the limitations that a security interest holder has under UCC Article 9. And so when you're talking about UCC Article 9, the limitations come down to first priority. This is always going to be true. The mezzanine financing debt is always going to be subordinate to either a bank loan or also to the bondholders. So if they do end up converting to equity and selling out their shares, they're still going to be subject to bondholders because that is a liability on the balance sheet. Second, the risk in this case is definitely a limitation for mezzanine lenders because the mezzanine loans are typically rated even below junk bonds, which are usually considered the most risky. And the risk here is not in the failure, it's not that there's a high risk of failure of these types of situations, but the lack of control once they get into them. And so this is really why they're rated so high. And this could actually have an effect on, if it's a company like Hatteras who has shareholders or something like that, then it may or may not be okay with the shareholders that a company takes on this type of risk. And so this could be seen as especially risky in the situation that Hatteras is in because their main goal in their business is not to provide financing for smaller firms. Their main goal is rather to make these boats. And so this isn't the type of thing that they usually engage in. So that is going to be an extra risk for Hatteras. Third, the mezzanine lender has no actual interest in real property owned by the company. So this is opposite of if a bank would give out a mortgage on a house. If the borrower does actually default on the loan, then the bank can come in, seize the property, and they have an actual piece of property that they can sell. And so this is different because with a mezzanine lender, their only real interest here is that they can turn around and convert to equity in the firm. And so the value of the firm will place the value of their equity, and having that equity for any period of time after it's converted could lower the value of that stock. And then last, the lender has to follow UCC Article 9 rules for getting the return. And so if they do decide that the borrower has defaulted, they can go in and get it back, but they have to be careful not to do it too soon because they're going to be subject to the same limitations that a security interest holder is subject to. So they could actually end up with some sort of a conversion charge or something like that if they did end up doing it too soon.
One of the major Article 9 limitations is the public sale limitation. And generally, the collateral that is given in a mezzanine financing is the equity in the company. And because of the nature of this collateral, a lender is generally limited to a public sale rather than a private sale of this collateral. The major reasons for this are that there's not really an established market for this type of transaction. So the collateral given is generally not going to be worth very much to parties that did not transact in it because of the terms that will attach to the collateral. And going off of that, there are no standardized price quotations for this type of collateral, again, because of the nature of the transaction and the terms that attach. And mezzanine loan collateral is also extremely complicated. Again, the terms that attach will make it difficult to transact to a party that didn't have a hand in creating the lending agreement. And so because of this, a secured lender can only purchase collateral that was given in a mezzanine loan through a private sale if it's of a specialized nature, which is very rare to happen, and most lenders who want to sell the collateral are not going to be able to find somebody who will buy it at a private sale, which essentially means that they're going to need a public sale if they want to sell the collateral.
So there are some other limitations outside of UCC Article 9 for lending through mezzanine financing. But again, just to reiterate, they are subject to privity, and so that's going to be kind of the biggest thing as far as the mezzanine lender is concerned. But outside from that, they do have a very small window of opportunity to kind of get in and recoup their investment. So as we mentioned earlier, there's a possibility for conversion. If they convert the stock too soon, then it's a breach of the contract for them. And so they have to wait long enough that it's not going to be illegal for them to go in and scoop up their investment, but they can't wait long enough that the borrower actually defaults on the loan or that they actually declare bankruptcy. And so this small window of opportunity is again where the risk kind of lies. Also, the mezzanine lender will generally lack protections which are typically provided in mortgages. So the rights of foreclosure are going to be riskier and of limited value because, again, you are getting shares in the company. And so the value of your asset really depends on how well the company is doing. And then last, even if there is a successful foreclosure on the mezzanine lien, the underlying mortgage is still going to be subject to the senior mortgage. So even after they do successfully go in and convert to the stock, if the company then defaults on another bank loan or something like that and the bank has a lien, then they're going to have to be subject to that. And so this is where we would really encourage, if we are a law firm and we are recommending to Hatteras that they should make this loan, this is where we're really going to be recommending that they contact the lawyers ahead of time so that they can kind of be with them through every step of this, because this UCC Article 9 and the other limitations to this lending are very tricky, and they really do need to be kind of consulting with attorneys throughout the entire process.
Even though it's very risky for a borrower to use mezzanine financing, it does have significant advantages. The primary one is that mezzanine financing is a hybrid of debt and equity. So while the borrower is getting a loan, which is treated as debt. They can also use it as equity in the cases stated before if they're going to a secured lender to get a separate loan on top of the mezzanine financing. Some secured lenders will treat it as equity in the company. And for purposes of the balance sheet, mezzanine financing also can be treated as equity. So if they need to bring a statement to shareholders, in some instances, they can also use the money brought in through mezzanine financing as equity. This form of financing is usually available very quickly, and it's for really when a company needs a loan and it doesn't have a lot of collateral and it doesn't have the luxury of going through the typical process of applying for and waiting for a traditional loan. For instance, in the Hatteras case and Grady White case, Grady White really needs this $3 million quickly to begin production of their new revolutionary boating line. They've already gotten a traditional financing, but they still need $2 million very quickly, and they presumably don't have a lot of collateral, so this is sort of ideal in this situation. Another benefit is that the company does not have to worry about the loan attaching to real property. As stated before, the collateral given is the interest and equity in the company itself, so there's no liens on real property as a result of the mezzanine financing, which allows the borrowing company to transfer property a lot more freely. And finally, with mezzanine financing, it's likely that there will be more total capital available just because mezzanine financing is so often used in conjunction with traditional loans through secured lenders like banks. And banks will typically have a limit on how much they can or are willing to loan to a borrower, but other companies, if they, like in this case, if they see a company that has a good product on the line or a good merger or leverage buyout on the line where they'll get a good return, they're typically more willing to lend a lot more than a bank would. And again, on the flip side of that, if a bank sees that another lender is willing to make an investment in this company, they might be a little bit less hesitant to loan a lot of money to a borrower.
So as far as the advantages for the mezzanine lender go, obviously the high rate of return is pretty much the biggest reason for getting into this type of lending. Generally, these run greater than 20%. That's just a huge return on any kind of debt. As I think Tiffany mentioned earlier, the bank loan is typically going to be like 4 to 6%. Second, the loan can quickly be converted to equity if the borrower doesn't pay it back or doesn't pay it in full, or if it looks like the borrower is going to default on the loan or declare bankruptcy. And so this is kind of an advantage in that while there is the short window to sort of realize that this is happening and kind of get in there and do it, the actual conversion of the loan to equity really doesn't take very much time. And on the next slide, you'll see these are two graphs, and the first graph on the bottom left-hand corner is a typical bank loan. This is where you see this is a normal J-curve effect, and this is basically the return on investment graph for a typical bank loan. So you'll see at the very beginning you have your initial cash outlay, and then as with a typical bank loan, the interests are lower, and they usually don't have to pay back for a very long time. And so when you have the initial cash outlay, there's going to be also an initial decrease in the return on the investment, because as they're taking all of this time to pay back their investment, the interest is also accruing. And so they actually have a decrease on the return on investment. And then it will start to spike until the point where it hits the break-even point and they actually recoup their entire principal. And then after that, as far as the return on investment is concerned, you see the rise in the interest rates that the bank will get. And it's also, this line is also going to be much flatter than with a typical mezzanine financing loan. And so that's what you see in the top right-hand corner. This is the inverse J-curve. And so you have the initial cash outlay of the loan, and then typically, because the interest rates are so high, and usually the borrower is trying to pay back the loan so quickly because to save money on the interest rates. So they'll start with an initial payment typically within the first year. And so you see a very quick and a very high rising return on investment in this case, because they really do want to get this money back. And so typically within 5 to 6 years, a loan is paid back and they've realized significant returns on their investment.
So in general, the mezzanine financing situation will work out well for both the borrower and for the lender. The borrower will pay the debt off in a short period of time, usually less than 5 years, and the lender will get a very nice return of 15 to 30% on their investment. And it's for the reasons Colleen said, the lender, the borrower is trying to pay off the loan as quickly as possible to pay as little interest as possible. So there's a lot less. There's a lot greater incentive to have the loan paid off as quickly as possible, and also the interest in equity that the lender gets allows them to sort of overlook the borrower's financial situation to capitalize on that small window of converting the equity and cashing out. That is generally the two characteristics which will allow for this to work, that the lender is incentivized to make the repayment as quickly as possible, and that the borrower is in a good position to ensure that the loan will be paid off.
So basically what happens if the company defaults on the loan is that there's going to be, again, this very short window. This is where this comes into play. So when the lender sees that the borrowing company's financial situation is starting to decline, or it's looking more and more likely that they're going to go ahead and default on the loan, it's very important that this is where the mezzanine lender steps in and quickly converts. And so this again is where we're going to recommend, if for any law firm who's recommending to any company who wants to lend in this manner, the legal company should go ahead and recommend to them that they consult on every single aspect of this, because this is the very most crucial part. And so you're really going to want to go ahead and contact an attorney before doing any of this, but it's got to be quick, and so they should be aware of this going into this kind of a deal.
In addition, if the borrower defaults on another loan, perhaps one to a senior lender, then it's going to be generally too late for the mezzanine lender to recuperate all or even most of what it has lent, which is again another role for attorneys to be involved here to oversee not just the financial situation of the borrowing company with regard to the mezzanine lender, but also to other lenders, to ensure that that small window is as clear to the lending company as possible, so that they can cash out and not be stuck with behind a senior lender in privity in the event of default. So if the borrower does default on a loan, at that point, the companies generally get to pay back the mortgages and other loans from the senior lenders first, and then the bond holders, then the mezzanine lenders, and then whatever's left will go to the preferred stockholders and the common stockholders.
Okay, so in the case of bankruptcy, this is definitely the worst case scenario. And at this point, this is generally where if a firm does get into this sort of thing, it's usually because they either haven't contacted their attorneys or because the attorneys weren't paying attention. And so this is the case where someone's getting fired or a malpractice suit is definitely imminent. This is not the case that you want to get to, and that's because the short-term quality of a mezzanine loan generally suggests that at this point, it's already going to be too late for the mezzanine lender to get any of its investment back or whatever is left from what the borrower still owes. And so typically what's going to happen is, even if they do file bankruptcy, by the time that the company goes and converts the loan to equity, then they're going to be basically holding equity in a worthless firm. And so there's not really going to be anything that they can do, because there's not going to be any market to buy back this equity. And so they're basically not going to recoup any of their investment. The plus side, however, is that by the time this firm would likely file for bankruptcy, especially in this case as they're already a firm who's doing other types of business, generally by this point, the mezzanine lender has already been paid back. Again, the short-term quality of the loan suggests, within 5 years they're going to be paid back. And so it's typically going to be very difficult for a company to take, in this case, a $2 million loan and just completely go bankrupt. And so hopefully by the time they do end up filing for bankruptcy, they will have recovered at least some of their investment. But this is not where you want to get to if you're still holding any amount of this loan.
So now we're going to make some recommendations based off the Hatteras hypothetical from earlier. And just as a quick recap, Grady White needs $2 million in addition to the $1 million loan they've already secured from the bank to begin production on their new line of boats. And Hatteras wants to provide the extra $2 million through mezzanine financing with a rate of return at 15%.
Okay, so we're going to make some recommendations for Hatteras, and then Josh will tell you the recommendations for Grady White. So Hatteras should consider making this loan under the following conditions. We believe the loan term should only be 4 years because of the nature of the investment. We believe they're probably ready to start construction here soon, and so if they're not paying back the loan within 4 years, then something's gone wrong. Next, we want to make sure that Hatteras retains some sort of operational or managerial control over basically the day-to-day finances of Grady White. They also want to retain the right to collect in the case of a mispayment or an increasing probability of potential default or bankruptcy. And then last, we would love for them to get some sort of extra protection because of the fact that Hatteras is not likely to ask for trade secrets or other IP from Grady White. They're not going to be taking any of that information, especially because they also could be considered a competitor. But so because they're not going to be taking this information, we're going to want for Grady White to be offering some kind of information. And so we're going to want a provision in the contract that calls for basically a right for damages if there's some kind of reasonable suspicion that Grady White is handing over misleading or incorrect information. And they're basically going to want the right to collect the debt in full and then sue for a breach of contract. And in the event of non-payment, Hatteras is going to want to retain the right to convert the loan to equity in the company, which can be sold to recover the value of the loan. And so this, again, is basically the purpose of this mezzanine loan. So the amount that they're going to convert to should at the time be equal to the remaining principal, which is due, and then any interest which has accrued that hasn't been paid yet. And so that's what they're going to want, definitely a provision in there that contains all of this information. Then for the repayment of the loan, they're going to want for that to be in increments beginning no later than 1 year after the initial cash outlay. And the payments should be semi-annually or quarterly, depending on either the preferences of Grady White or for Hatteras if they have some sort of specific request. As for missed payments in the contract, Hatteras is going to want to have a provision in which they might allow for a missed payment or the deferral of a payment at the request of Grady White, but they're going to want to make sure that the provision does not tie their hands at all, because if there is a missed payment, they don't want to be stuck having to negotiate for a deferral of a payment. And if they do believe that that missed payment is indicative of a declining financial situation for Grady White, then they want to be able to go in and swoop up their investment.
So for Grady White, they would generally, and most importantly, they would want the provision that Colleen mentioned, which protects their intellectual property and their trade secrets. In return for giving that protection, Grady White would probably acquiesce to the good faith updates that Hatteras would request about the financial situation of the project and of the company as a whole, so long as it's, again, protecting general trade secrets related to the project and other endeavors. Those good faith updates might include projections about rate of return, the progress of the production of these new boats, and what their projected sales based off of the new production line would be, and any events that might prevent the sale of these new boats from occurring behind schedule. And in the event of a mispayment, Grady White would probably seek the provision that would allow them to defer the mispayment, or at least negotiate for the mispayment on the loan. And basically, Grady White is looking for the assurance that if they miss a payment, that the loan will not become due in entirety, and that Hatteras would not take that to mean that they have to act on the small window and convert their equity and cash out and make the rest of the loan due. So in all likelihood, they're not going to get the absolute protection that the loan won't become due in the event of deferral, but they would at least want to request that there be a provision that they can in good faith negotiate for a deferral. And finally, Grady White would want a provision which limits the managerial control that Hatteras is going to get in the company because of the equity that the lending company gets in mezzanine financing. Hatteras will be entitled to some degree of control, but Hatteras would, want to keep day-to-day operations and big managerial decisions at their discretion. Maybe they would allow Hatteras the opportunity to give their input, but retain the last say or final decision authority for themselves. For example, while Hatteras is going to have the right to look at the financial statements and projections about the project, Grady White might be willing to allow Hatteras to make some recommendations about how the sales or production of the boats should go, but they probably would want in a provision that protects their absolute right to make those managerial decisions themselves. And this is one of the big risks for a borrowing company, is that there is going to be this intrusion of the lending company, that they have this managerial discretion, and smaller held companies or family companies might not want another lending company being able to influence their day-to-day operations in any way. And this control provision would be made with the knowledge and acceptance of if Grady White gives materially misleading information or incorrect information, that Hatteras would probably take that to be a bad faith breach and therefore would want to make the loan past due. So that would give Grady White an incentive to want to keep Hatteras in the loop and give them accurate information, but still retain their managerial discretion.
Okay, so in conclusion, basically we believe that Grady White is going to be the more lenient party in this situation. This isn't always how it goes. Sometimes the mezzanine lender just sort of loans the money and then asks questions later. It's usually a very fast-natured process. However, because Grady White really does need this money and they can't get the bank loan, it's unlikely at this point that another bank would end up being able to loan them the extra $2 million, especially because they already do have this $1 million loan out. And so the bank is not going to want to take a secondary position on the same collateral that another bank already has. So we believe that Grady White is definitely going to be more lenient. However, there is a foundation here for a successful mezzanine finance loan. We just believe that for both of these parties, as they kind of go along this whole situation, they should be consulting with their attorneys, especially because we do believe that there's a little bit more time in this particular situation for them to go ahead and speak with attorneys and actually make sure that their interests are protected, because they do have kind of some more time, not really a whole lot, but they really should be making sure that they're making their interests protected, especially as both of these firms are not really typically businesses that sort of enter into these kinds of mezzanine loans. And so depending on the various provisions of the contract, mezzanine financing may or may not satisfy each party's goals, but we do believe that there is a foundation for a very successful mezzanine finance loan. So, thank you.
Thank you.